This video was made possible by Masterworks. More on this in a bit. As you've probably noticed, VisualEconomik community, the international news is increasingly pessimistic. Everything indicates that we are about to experience the next global crisis of this generation.
US economy just had second quarter of negative growth. GDP decreased at an annual rate of 1.6%. Is it in a recession?
We've already told you about it on this channel. In order to fight against runaway inflation in 2022, the central banks of the Western world would have been forced to raise interest rates. And that means two things. The first is that companies, families, and governments will have to pay more and more money in interest, so they will have less purchasing power in their day-to-day lives. The second is that borrowing to set up new businesses or to buy homes will be much more expensive than before, which basically means the demand for goods and services is falling at the speed of a Formula 1 race, which could be the trigger for the next crisis. And believe me when I tell you that this is all something that has already begun to be felt in the real economy.
Builders are stuck with too many houses as US buyers pull back. In an American housing market that, for years, has been plagued by too little inventory, builders are suddenly finding themselves with a glut of unsold homes.
It is a fact. The US economy has already begun to slow down, and it is only a matter of time before this slowdown begins to spread to the rest of the world. You know that old saying, when the US sneezes, the world catches a cold. So if we want to know how the economy will go in the rest of the world, we first need to look at how it is developing in the United States. Even more so, if we take into account that with the energy crisis and the Chinese slowdown, things in the rest of the world are not exactly racing. However, let's pause for a moment. Despite this bad news, and despite the fact that day after day, many economists and experts insist on predicting some future disaster, the truth is that there is another branch of economists who suggest that we will not really see any major crisis in the near future. These economists say that even if the economy slows down for a few months, this slowdown will only be a small market correction, so that the economic boom will take off again, and everything will be going swimmingly once more.
Recession may not come after all, economists say. Economic strength defies forecasts of downturn, but risks remain, experts said.
Yes, I know what you are thinking. Economists are a disaster. Some say there will be a huge crisis. Others say none at all, that there is nothing to worry about. So, can anyone be right? And the question is, who is right in all of this? Should we fear a new crisis, or should we relax our alarmism? As we've already mentioned several times on VisualEconomik, economic analysts are not seers. It is very difficult to know what will happen in the future, and that is why there is always a diversity of opinions. But what we can extract are some very important clues and indications. Be that as it may, in this video, we want to explain to you the reasons why we can remain optimistic. We want to show you the data that supports a calm approach, and that signal that a new economic boom could come very soon. So tell me, do you want to know exactly what the keys to hope are? Do you want to hear about the good data and the positive outlook for the current economy? Well, today on VisualEconomik, we will tell you all about it. But before we go on, let me tell you something that I think will interest you. Surely we can all agree that whether it evolves for better or worse, the current economic moment is fraught with uncertainties and risks. And of course, many voices keep repeating the same word: recession, recession, recession. With energy prices skyrocketing and central banks raising interest rates and tightening monetary policy, the stage seems set for a new crisis. In fact, 3/4 of Fortune 500 CEOs estimate that we will soon see negative growth rates. And according to Goldman Sachs, the probability of the United States falling into recession in the next 2 years is almost 50%. Faced with such a scenario, the question is, how can we protect and diversify our wealth, particularly when inflation is breaking 40-year records? Well, according to Deloitte, 85% of asset managers recommend art as an asset to include in our portfolios. But okay, I'm sure many of you are thinking, what does this have to do with me? How am I going to diversify my portfolio with works by Basquiat or Warhol, which are worth millions of dollars? Masterworks is a service that allows us to invest in great works of art through small holdings. With Masterworks, you can co-own expensive pieces of art that can help diversify your wealth and protect it from inflation. And who knows, they may even help you earn a nice return. For example, investors who bought Banksy's Mona Lisa with Masterworks achieved an annualized return of 32%. We'll leave a link to Masterworks in the description where you can find all the information. What's more, you can skip the waiting list to register by using the link below. And as always, in everything related to investment, use your head. Nothing is risk-free. As we saw a moment ago, the United States has begun to enter a phase of economic decline. To be specific, during the first and second quarters of 2022, GDP declined by 1.6% and 0.6% respectively. In any case, the interesting thing about all this is not that there has been a significant decrease in GDP. What is important is what you are going to see below. In this graph, you can see how job creation has been evolving in the United States since January 2021. And yes, the more astute of you may have already noticed that one thing doesn't fit. In this chart, July 2022 was the month in which most jobs were created since February. And in case you were wondering, yes, August was also a good month. So we have just said that the economy is slowing and in decline. A bit contradictory, don't you think? That is to say, normally in a crisis, what happens is that jobs are destroyed, not that they are created in abundance. Yes, it is contradictory and very strange. In fact, analysts around the world expected July and August to be precisely the months with the least job creation since April 2021. However, that was not the case. The summer in reality far exceeded the expectations of the experts and practically threw all economic logic out the window. But wait, because that's not all. If we look at this graph showing historical unemployment, we can see that the current unemployment rate in the United States is not only low, but also the lowest on record since 1969. Or, to put it another way, that despite high interest rates, despite massive inflation, and despite countless warnings of impending crisis, as far as employment is concerned, the United States appears to be in its best shape in 53 years. Many of you are probably already asking yourselves, how on earth is that possible? How can we explain that while GDP is falling, employment is registering record figures? Well, pay attention, because I assure you that the answer to these questions will blow your mind. And hold on to your chair, because there are plenty of curves ahead.
Where are all these jobs?
Although the unemployment and employment figures we have just shown you may seem like a real success in the US labour market, let me tell you that these figures hide something very curious. Take a look. In this graph, you can see the evolution of the total number of wage earners working in the United States. As you might imagine, with the pandemic in 2022, employment plummeted, but since then it has been recovering until finally, in July 2022, pre-pandemic employment levels recovered. So far, so good. Excellent news. Nothing remarkable, right? Well, wait a minute. Let's not cry victory so fast. Let's go back to the graph. If you notice, until before the pandemic, employment was growing steadily with a very strong trend. A trend which, if we draw it on the graph with a red line, will allow us to see that if the pandemic had not happened, then employment at this point in 2022 would be much higher. So, I hate to say it, but it's not quite true to say that the pre-pandemic employment bonanza is back. Even though recent employment data is good, well, it's not stellar either. We would have been much better off if the 2019 trend had continued. Now, does all this mean that Americans are having trouble finding new jobs? Is the downside that there aren't enough job openings to bring back that pre-pandemic job growth trend? Well, the answer is no, quite the opposite. The funny thing about this whole thing is that if the pre-pandemic employment trend hasn't yet been surpassed, it's simply because American workers haven't wanted it to. As absurd as that may sound, if the US had not recovered its employment dynamism, it is because Americans have not wanted to work more. Wait a minute, does this sound like an absurd theory? Something we've pulled out from our sleeves? Well, far from it. Check it out. The orange line you are seeing right now represents the evolution of registered job openings in the US. On the other hand, the black line represents the active population, that is, the number of people who are working or willing to work. Understand that what is happening right now is that while job openings are at record levels, the number of people wanting to work is far, far below pre-pandemic numbers. This massive abandonment of the labour market is partly due to the aging of the population. You know, more and more older people are retiring, and even more so after COVID. However, according to Jason Furman, an economist at Harvard University, about 70% of all those people who have stopped working in the US are perfectly capable working age adults. Indeed, the vast majority of them are citizens under the age of 55. And take note, because although this may seem like a serious problem, it actually hides wonderful news in terms of avoiding a new crisis. What does the fact that so many people have left the labour market have to do with saving us from a new crisis? Well, let's take a look.
Relax, guys, there's a margin.
As I said at the beginning of this video, in general terms, what is most concerning about the new crisis are the interest rates. You know, more expensive mortgages, less investments, more expenses. Things, as I have also mentioned, that are beginning to impact sectors such as the real estate market. But beyond this, there is another major element affected by all this context that we have not yet mentioned, an element that you're going to see illustrated on screen. What you see on the screen represents the amount of savings that US families have accumulated over the past few years. Notice the detail that since 2020, there are several peaks where US savings skyrocketed. As you can imagine, these spikes can be explained by the fact that the administrations of both Donald Trump and Joe Biden decided to hand out money left and right to the population in response to the COVID-19 crisis. And the interesting thing is that according to some economists, this extra money that many obtained motivated the abandonment of the labor market. In other words, why work and put up with an unpleasant boss when you just have fresh money in the bank? Then if we add to all this the other elements, such as fear of the coronavirus, the fear of inflation eating into your salary, or the lack of certain services such as childcare due to the pandemic, well, there we have it. Lack of workers assured. American workers have less incentive to work. However, the fear is that this large mass of unemployed people may have very little time left to live on their savings.
Many American households use stimulus payments to pay down debt. Household Pulse survey shows stimulus payments have eased financial hardship.
According to the US government, more than 60% of households that became unemployed after the pandemic used part of the stimulus packages to pay off their debts. And of course, as we have said, rising interest rates precisely affect debts, something that partly explains why after the 2022 kickoff, American savings have plummeted to lows not seen in decades. In short, we could say that savings have run out. Now, many more people will have to be encouraged to enter the job market if they want to pay their bills, which, come to think of it, would mean that rising interest rates, indirectly, will have encouraged new job creation, which, hypothetically, could be behind the huge July 2022 employment increase. Although, be careful, because this is a hypothesis that will have to be confirmed with time. Having seen all this, and to summarize, everything indicates that unemployment in the United States is not going to suffer a great catastrophe in the coming months. Quite the contrary. Job opportunities for Americans facing economic problems will be very, very ample. But then, how can we explain the fall in GDP in recent months? This is partly explained by the fact that sectors such as manufacturing have slowed slightly. In addition, wages in sectors such as leisure, which were highly inflated after the pandemic, have moderated their growth by about 50% in recent months. And above all, it is worth noting that, although growth between 2021 and 2022 remains negative, the fact is that between the first and second quarters of 2022, GDP has managed to recover slightly. So yes, the US is technically in a recession, but not a very solid recession. Hence, neither the Federal Reserve nor the National Bureau of Economic Research has officially declared it yet. As if this were all not enough, aspects such as the strengthening of the dollar, the fall in commodity prices, the end of bottlenecks, and a Chinese crisis that lowers import prices indicate that inflation easing could be closer than ever. And even if it were not, even if inflation did not fall below the 2% target, many leading economists are already opening the debate to the Federal Reserve, prioritizing growth over inflation in the event of a catastrophe.
When, sometime next year, inflation gets down to 3%, there will be an intense discussion of whether it is worth slowing down activity further to get to 2%. The Fed may decide to state mission accomplished and stay at 3%, if not forever, at least for a while. Oliver Blanchard, former head of the International Monetary Fund.
Unlike the European Central Bank, whose main mandate is price stability, the US Federal Reserve aims both to control inflation and to defend US economic growth. So even if the labor market did not save the situation in the face of a new crisis, or inflation could not be corrected as economists expect, the Federal Reserve would always have an ace up its sleeve to control the situation, at least for the time being. That is, to cut interest rates again. Be that as it may, I am sure there is now a question that many of you will be wondering. Is this US optimism applicable to the rest of the world? Will regions such as Europe or Latin America suffer the same fate? The answer to that question is that it depends on each country and on each nation's fiscal and monetary policy. In general, however, the International Monetary Fund, which revised its forecasts at the end of July, predicts that the global economy will grow by 2.5% in 2022 and 1.4% in 2023. However, more concretely, for example, in Latin American countries, the North American recovery is likely to have a very positive impact on their trade dynamics. Countries such as Venezuela and Ecuador, which export oil, are also likely to benefit from the global oil shortage we talked about in one of our videos. In any case, you know that every country in Latin America is a world of its own, and comparing the future of countries like Venezuela with countries like Uruguay is simply impossible. On the other hand, as far as Europe is concerned, countries such as Spain registered one of their highest job destruction figures in 14 years last July. In a previous video, we explained that the case of southern European countries is very particular. Their huge public debts put not only their public accounts in serious trouble, but also the very stability of the euro, which has lost much of its value against currencies such as the dollar or the Swiss franc in recent months. We could say that Europe's big problem will not be a short-term crisis, but a longer chronic disease. Although, well, we have already covered that in several previous videos. Be that as it may, possibly the biggest concern for Europe is the war in Ukraine, and therefore the best news it could receive would be a sudden drop in inflation. This could be due to the end of bottlenecks from Asia, a drop in the price of raw materials such as oil, or even the development of new energy sources such as LNG. However, the end of inflation is what we will talk about in detail in the second part of this video. A video that will complement everything we have explained in this one. A video that will focus exclusively on the inflation issue. So until then, the questions are over to you. Do you think the US labor market will manage to boost the US economy with high interest rates? Should the Federal Reserve cut interest rates in the event of a new crisis? Will Europe and Latin American countries be able to follow in the footsteps of the US recovery? You can leave your answers in the comments. And remember that you can highlight your contributions with the thank you button, and that by doing so, you can also financially support the independent media that is VisualEconomik. If you like this video, please like it, activate that little bell so you don't miss any of the following videos, and I'll see you in the next one. All the best. See you soon.